everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today we have the pleasure of interviewing Chris Vermeulen of the Technical Traders. How you doing today, Chris?
I'm good, Daryl. How are you?
I'm doing all right, day by day process, but life always comes with its ups and downs. And speaking of ups and downs, the markets have been kind of in a weird territory, especially with the conflict in Iran. It's been like a coiled spring at times where, it gets oversold and then some announcement comes out of like a peace deal or ceasefire, and then the markets just roar and rally significantly higher. Then, it's kind of been a whipsaw, seesaw or whatnot. And so curious in your thoughts on market behavior right now.
Yeah, I think there's a lot going on. The Middle East has definitely caused a lot of the markets got sold off. They got a little oversold there and it stretched to the downside, just like a spring, right? If it gets stretched too far, too fast, usually it's going to recoil and go the opposite direction, which is what we're seeing right now. We really had, at the end of March there, we had multiple different time cycles come into a bottom, created a very significant standout low. And the market has kind of gone from a bounce into a rally mode. And now we're literally less than 0.5% away on the S&P 500 from all-time highs. So it's pretty interesting. I think a lot of people are caught off guard. I think a lot of people got short, expecting the market to break down. And here we are, like literally feels like a couple of days later, we're almost at all-time highs again. So this market is all over the place, driven a lot, I think, by the Middle East and by the price of oil. Oil's been affecting the inflation fears, which trickles into interest rate movements, which directly drives like the bond prices. So we're seeing all of that really, really take place. And we can dive into the charts here too. And, you look at the precious metals space and everybody was all excited about it. And then we had that huge correction. And it was pretty much like, they got everybody who's in the metal space just got like punched in the face by Mike Tyson, right? So now everybody's staggering in the precious metals space, and metals now are just moving with gold, with the equities market. If stocks are up, gold is up. If stocks are down, gold is down. And it doesn't matter if there's good or bad news, gold just follows the price of stocks. So right now, everybody's just like dazed and confused in the precious metals space, I think, in terms of short-term price swings. And it's really just the short-term fear and greed of equities traders is flowing into the metals pricing.
Mm-hmm. Can we look at the S&P? It seemed like the S&P was like it was about to roll over when I was looking at the charts, but then you just mentioned like it's already back, within like 0.5% of all-time highs. So I'm interested in like what the heck, Chris?
Yeah. Well, we've seen the stock market. So this is the daily chart of the S&P 500. We'll just zoom in a little bit more here, but we have been seeing the S&P 500 in the big picture here. If you just look at it, it really has been trading sideways. It's just been coiling, as you mentioned, just chopping sideways, barely making really higher highs. And then of course we had the news with Middle East. The market got stretched to the downside. We had multiple cycles, 3 different time frame cycles bottoming out, and now we've just had this huge pop. I think a lot of people thinking the Strait of Hormuz is going to slowly get resolved and it's not the end of the world, and suddenly we're seeing money start to move back in. And it's interesting because as the stock market was selling off, we actually saw a lot of money moving into utilities, consumer staples, dividend stocks. We saw a lot of money, holding up and moving into that space. But right now, this leg that we got going higher here, Daryl, is like risk on mode. We're seeing small caps. We're seeing micro caps. We're seeing the semiconductors hitting all-time highs day after day. So there's a lot of money pouring back in. And we saw this on our strategy and our momentum started to tell us that we went from red bars on this 30-minute chart on the left-hand side here, saying, hey, the momentum is shifting, and then we kicked into an uptrend, and now here we are. If we were to just take the high of this morning to the high that we saw a few months ago, we're less than 0.25% away. We could be at all-time highs by the end of the day, no problem. And that is going to, I think, kick into the news kind of scene. Everybody will start talking about the S&P 500 all-time highs, and anybody who's short is going to have to start to cover. And so we could see another big push higher in the market. And I think a lot of people aren't expecting it. When we look at the big picture of the S&P 500, and this is very similar, the NASDAQ, pretty much the same thing. We had a confluence of multiple cycles, what I consider a standout low or a intermediate cycle low. This was after the tariffs from last year. We just had another confluence of the same three cycles, putting in another low. We had the war fear. It doesn't matter what the cause is, what the news is that drives it. It still comes into the markets have these wave-like cycles that roll through it. And so now we're back into this big move, but we can use Fibonacci extensions, which is a great way to identify targets. And based on this big rally to the upside and coming down to this low, we can get a rough idea of where the next targets for the S&P 500 are if this market wants to keep ripping higher. And so you can see these levels. The next level from where we are right here. Now, I'm not saying it's just going to scream straight there. It could take months. But overall, we got about a 10% upside move. So the S&P 500 could move to 7,700. It could potentially go into a euphoric blow-off phase and go very vertical and go up to about 8,500 on the S&P 500. So there is potential based on the chart pattern for a huge move, which I think had a lot of people off guard. Now, as you know, and I've been on your show many times, I'm generally a pretty bearish person in terms of my views. I'm always looking out. I'm like, when are the markets going to correct? What are the downside potentials? It's not that I bet against the market. We are long. We ride this market higher, but we always have to have a game plan because at any point, one of these pullbacks, for example, if I was to just zoom back on this chart, rebalance it here, any one of these pullbacks could be one that ends up turning into one that goes a whole lot lower and really wipes out the market and takes years to come back. So I'm always on the defensive side. I'm always bearish, always telling you to be like, make sure you got a game plan. This market could roll over at any point. And so that's kind of my focus. But the equities market here has potential still for some euphoric phase, maybe like SpaceX and OpenAI and all this stuff just creates this next feeding frenzy. Maybe semiconductors, SMH, which if we just pull up really quickly here, which are screaming to all-time highs, maybe we're going to see one more big push. And SpaceX and all this is just going to lure in a ton of money and drive the markets higher. We just have to wait and see. And this is, as you know, my whole angle here is just follow price. If you know the trend is up, make sure you own something, you're long. If the trend is down, make sure you don't hold it or be in something that benefits from falling pricing. So the equities market, as bearish as I am for the big picture, I do believe the big end is coming. We're going to see a 40, 50, 60% correction in US equities. Until it starts, you have to continue to be long in this market. And right now we are, testing all-time highs as we speak.
Yeah, definitely. It seems like, like we get these sell-offs and we're waiting on the confirmation of going lower, and then the market pops back. And so, I'm curious. So along the lines of this SMH, I've been looking at these stocks like SanDisk, Micron, MU, ticker MU. These are like these these storage, space like SD cards and stuff. And I'm just like, what the heck is going on? Is going on here? Because I remember at VRIC, one of our media guys, Miles, he was saying like, hey, I had to go secure these multi-terabyte SD cards for our footage. And they costed like, I don't know, a few $1,000 or whatever. Yeah. And I was thinking like a few $1,000. And then it turns out like there's a huge, rally in these equities where, storage space is becoming a problem. Well, I mean, if you look at it, like it makes sense. Looking back now, it's like AI has been a huge mover and shaker, and the semiconductors and all that stuff, massive moves. But you think of it, the more AI there's more. That means there's that much more data to store. Like the amount of data that AI just produces, and you got to save it. It's got to be stored somewhere. I mean, it makes sense that we're going to need insane amount of storage. And the proper good storage devices are amazing. I mean, I'm into some electronics and programming and coding, and I created these sensors that record weight loads and some weight sensors for something I'm working on. And it can, it was only getting about 4 readings per second. And then I was reading, I'm like, well, if you get a high speed, a high quality
mini SD card, micro SD card, it'll write and read a lot faster. And so I got it. And now I can do like 11 measurements on this thing per second, giving me much more accurate for something that is moving at a fast rate back and forth to find the peak loads. So, I mean, the leaders in storage, I think, is huge. It makes a massive difference. And it's going to be needed more and more. The more AI, the more storage we're going to need, because AI can process and create more data faster. So we need to be able to store it faster. So this makes sense. Yeah. There's no doubt we're in a big consolidation here. If you look, we had a huge run up, and then it had consolidated. A huge run up. It's consolidated. Another huge run. It's a volatile one, but it's consolidating, and we could see this keep pushing higher. So, the tech space is really, really big here with AI. I mean, there's so much that AI is feeding into. And one of my kind of examples is like, I used to watch this show called Gold Rush, and, some of these guys don't make any money. They come back on, they like lose every year. The mining companies, some of these companies don't make anything. The people who make all the money are the people who supply the fuel, who supply the semiconductors, the chips, the power the units. So, that's what these are. It doesn't matter how successful AI is. You still need storage. You still need processors, all of that stuff. So I like these plays. I almost feel like, they're the lower risk type of play, because it doesn't matter which AI company blows up. They're still going to be buying all this equipment to start their business, to run their business and all that.
Mm-hmm. Yeah, it's interesting with AI because there's it seems like a bigger push even in the mining industry to include AI in many different facets. And so I've been talking with multiple companies about how they're using AI within the mining industry, within the whether that's looking at projects or finding old projects that used to be mined, to jurisdictional risk and deposits and all of that stuff. And so it's interesting just how AI is getting woven into many different facets of industry.
It's everywhere. I mean, I've been looking at so many different companies and valuations and all these private companies raising capital. It's funny. You look at the spectrum of them all. All the ones that have the letters AI in it get like 10x the funding as everyone else. It doesn't matter how stupid or how weird the idea is. It just goes, everybody needs to be in it. And I mean, you could argue every company's using AI. I mean, who doesn't use ChatGPT or Grok or Claude to do a lot of their stuff? I obviously, there's a whole new level if you use it to run and refine things even more. But I mean, AI is just tagged onto everything now. And it really, to me, feels like it's kind of like, window dressing or like greenwashing for products, right? They put a green leaf on it and everybody naturally thinks they're like eco-friendly, right? So everybody's doing that with AI just to boost their appearance, boost their sophistication look. But anyway, this is just the reality of it. This is the way the world works. Everybody always tries to get their edge and do whatever they can.
Yeah. So what's going on with the Dow? So the Dow was touted at 50K. I think it came down to 45,000. Where we're at on the Dow again?
Yeah. I mean, the Dow's doing the same thing. I mean, it's kind of underperforming a little bit in terms of where the S&P 500 is threatening to hit all-time highs. But I mean, all these indices, they do move together, right? They all put in lows together. They generally all put in highs together. And, it's really just the ocean tide, right? It's some of them just outperform or underperform at different times. I got a feeling maybe the Dow's underperforming a little bit here simply because energy stocks have pulled back for the last couple of weeks. And so I think we're seeing maybe energy struggling a bit. I mean, the Dow's got some pretty big companies, big dividend companies. If we go and look at the SPYD, the dividend stocks are nowhere near the highs. They've really just slowly ground their way higher. And so money right now, for example, if you look at the dividend stocks, they've really just inching their way up, actually been moving down the last few days as the stock market has been screaming higher. Nobody wants utilities. Nobody wants dividend stocks. They all want micro cap. And if we look at the micro cap space, the same chart, micro caps have exploded and they are literally in striking distance today of hitting all-time highs. So it's just the Dow has got the big, boring companies, that everybody already knows. It's not very exciting. They all want to get into micro caps, small caps, AI technology, stuff that supports the AI movement. And that's where money is flowing right now.
George and his team, a 16-year VRIC employee building some of their largest mining operations on the planet. We started a drill campaign. From the drill campaign, moving into a full engineering report and study. We came out with our pre-feasibility study in 2021, and it showed a really impressive economic case for advancing the project. We'll have final definitive feasibility out in December of this year. So in the space of 4 years, fully engineered, fully permitted. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
So what's going on with the dollar? I know that the dollar did catch a bid, and then it looks like we're selling off now.
Yeah, I mean, the dollar's trying to carve in a big bottom here. This is a kind of a major resistance area. It got up to about a week and a half ago. It's been rejected back down. I do think the dollar is trying to put in this rounding formation. So overall, it's slowly going to work itself, I think, out of it. And I do believe at some point we're going to see the equities market put in a major top. We're going to have something that tips the scales. And then suddenly, once that global fear hits, we're going to start to see the dollar really start to scream and take off and move to the upside. But right now, it is still trading in what I would say is a stage one base. So this is a kind of a trendless dead zone. You don't really want to get involved in the dollar here in terms of trading it. It's really just noisy. It's just going to flip and flop back and forth. So the dollar here is carving out a major bottom. I believe it's an early warning sign in terms of what's unfolding. When we look at precious metals, they're looking like they've potentially put in a blow off a significant high, and they're putting in a potential top. So if the dollar breaks to the upside, that probably means we're going to see the precious metal space have a big sell off, along with probably equities as well.
Yeah. Let's go ahead and transition to the precious metals. You mentioned a potential blow off top. That's concerning, Chris.
Yeah, well, I mean, let's look at the zoom back on gold a little bit. So gold has been doing exactly what you'd expect it to do. It has been moving higher as fear and chaos continues to pick up speed. Really, right around here is where we started to see precious metals explode. This was kind of July last year. It's when gold really started to become mainstream. We started to see everyone pile in, and huge numbers were touted for where it's going. We ended up seeing this huge move. So I think this phase right here was a blow off move. I mean, we exited our gold above 5,000. We closed out our physical gold position, moved aside. We had a short-term trades in there as well. We played a move right in here. We also played another move right in here. On top of our physical gold positions, we just wanted to take advantage of these emotional mass psychology euphoric phases. So this euphoric phase typically gets wiped out very quickly. If we go and we look at this chart that I've shared with you before, this is that euphoric phase right at the top here, where things just kind of go explosive. Everybody thinks they're going to be rich. Everybody's a genius. Gold's the best play, and usually that's when you see a huge correction. It stutters for a while, and then it falls out of favor. And I've seen this cycle rinse and repeat many, many times in all different asset classes over the last 26 years that I've been trading. And so we've got this blow off phase. Now, if we were to zoom in on the chart of gold a little bit here and use Fibonacci extensions based on this most recent move, I find this is the most powerful tool. It's very accurate in telling you where price is most likely to go. So based on this chart of gold saying, okay, it's sold off down to here, it's rebounded back to here. Based on that drop and that bounce, it is telling us that gold should go to about 4,000 and then about 3,500, which, if you look, also happens to be the point where the switch flipped, where the mass psychology and FOMO kicked in and everyone had to get involved. And so the market is very good at anybody who chased price up in the last, final hours are going to pay the premium and more or less not only give back their gains, but they're actually going to go into a deep loss. So, I mean, where gold is right now, I think we could see about a 25% correction from where it is. And I see this as a huge opportunity. I think if gold pulls back here, that also means the equities market is crashing. I think it's going to be an unbelievable opportunity to reload in gold from where we exited with our strategy, which was to get out right up into this area over here. Nothing like being able to buy it back at a huge discount and then ride the next wave. Because I do think eventually, in several years from now, potentially, we're going to see gold at 8,000, 12,000 and beyond. I'm a gold bug. I think it's very good, but I also can get rid of it when I think things are a little overdone and it's going to need some type of correction. And so that's kind of my view on gold. Now, silver is very similar, but before we jump over to the silver chart, I just want to kind of show my downside potential is about 3,500 for gold. That may take 3 months. That could take 12 months. Who knows? It might take a long time to unwind. If the stock market rolls over and sells off for 6, 8, 12 months, we could see gold slowly drift down and sell off. And I don't want to waste that time. I'd rather benefit from inverse ETFs. If the market's falling, I want to benefit from falling pricing. I don't want to just give back 40, 50% of my gains in gold and then wait years. I want to rebuy it at a cheaper price. So that's my bearish outtake. The bullish outcome here is we do have this big move up. It is putting in this giant bull flag. And whether it continues to flag out here and potentially come down even further, it's going to be a great opportunity at some point when it starts to break out to get long again. And then I think we're going to see that go and have a huge move. Also, we could see gold start to move up and start to build a bull flag and a launch pad and really start to break out and have another huge run and maybe go for one final blow off move. And maybe we see $7,000 or $8,000 gold. If this is the case, our strategy will say, okay, it's time to get back in. This wants to go for another run. Let's hop on and ride this bull even more. And so I don't really care what it does. I just don't want to be stuck holding something for 1, 2, or 3 years with no return. And to watch, 30, 40% of my gains or potential upside get wiped out when there's no need to, because we can follow price. So that's my take for gold is we just have to wait and see. The easy money has been made. Now we're waiting for the next setup. And, when we got into gold, I only trade precious metals with these massive kind of super cycles. And so the last time we got into gold was right over here. 2019 is when it broke out of this base. This is kind of what the dollar is doing. It's built this, this flat level, this rounding base. That's what precious metals did. And then we also accumulated more on the COVID crash right here. And then we sold like right up here. And so I'm waiting for this next reset. And I don't know if it's going to take 3 months or if it's going to take 3 years or 10 years like last time or even longer. So that's kind of what I'm looking for, my focus on trading precious metals. I don't want to ride this roller coaster when there is absolutely no need to if you understand how to read charts and sentiment and manage a portfolio.
Yeah. Okay, so is this pattern, so some people have been mentioning the 2008 scenario where gold rallied, sold off with the markets, and then rallied significantly from there. And so curious if we could look at that period. Do you see any patterns with that?
So we could see something like this. So this is the 2008 peak right over here in gold. We did see gold have a correction. It pulled back 34% from the high. And then from there, it was fairly short-lived. I think it was only like 8 or 9 months or so. And then suddenly it took off and it had that second big move. That's what I kind of feel like is going to happen here. I think we're going to see gold and things pull back. And then we're going to see it like ramp up and go absolutely ballistic for many years. I think it's going to get stretched out even further. And I think we'll be up in the teens, right? Like, 13, 14,000 for gold, something like that. When you look forward 5, 10 years from now, it'll be a great value. That's ideally in a way, that's what I'd like, because then we can get some very big returns quickly. My only concern is like looking at it from, if we have $10,000 and $15,000 gold, I mean, man, it really worries me what the world will be like, right? It could be real ugly. There could be a lot of war. There could be a lot of robbery and theft and all kinds of stuff. This is high gold prices we don't really want, because it just means we're living in a more uncertain, a very higher risk kind of environment. So in a perfect world, gold goes dormant and does this for the next 14 years, and the world stabilizes and the market has a little reset, and then we start a new bull market and all of that. But if gold keeps screaming and silver takes off to 200 and change plus, it might not be the most exciting life that we're living, right? Like I just renewed my gun license. I haven't used it in over 10 years. And I'm like, I'm renewing my gun license and I'm just getting prepared. I think when push comes to shove, if all hell breaks loose, you need precious metals, physical, because internet could go down, or who knows, or AI is controlling everything. Once AI takes over and can hack every system, we're really screwed. And I think it comes down to like physical metals. Crypto will be worthless if like the internet's hacked by AI that's like done it all, right? So you need physical metals, you need food and water, and you need bullets. Like that's how you control the world.
Yeah, for sure. For sure. So I'm curious if you, in your view, also how M2 money supply plays into this. So obviously, massive debt deficits. This is all going to have to be funded. Actually, let's look at, before we go to silver, can we look at bonds, the behavior of bonds? Like, it seems like bonds aren't necessarily the safe haven anymore. And central banks have been buying gold. I think China sold a lot of treasuries. And just curious in your thoughts here, because someone's going to have to fund this amount of debt and deficits, and it seems like there's going to be a lot more money printing.
Yeah, I'm not a big fan of the bond market. I mean, if all hell breaks loose, the markets tend to do what most people don't. The majority of people aren't expecting, and I don't want this to happen at all. But there is potential. Like we saw a 40-year climb in bond pricing as yields fell to like near zero. Now we've got this giant move to the downside. It is creating what is actually a very, very bearish chart pattern. If it breaks to the downside, we are going to see a huge unwinding event in terms of bonds. And we not only will bond prices fall, because we're probably going to see like inflation, we're going to see all kinds of chaos. We're going to see interest rates probably spike up fairly dramatically. Bond prices are going to fall, but then there's probably going to start to be defaults. It obviously depends on the type of bonds, but you get into corporate bonds and high yield, high risk junk bonds. There's going to be a lot of things imploding. We saw this in 2008. I mean, companies were going bankrupt left, right, and center. Defaults everywhere. It doesn't matter if it was school loans and cars and homes and like business loans, equipment loans. Like everything was just default. Everybody's just walking away, saying, "You know what? Screw it. I'm just starting fresh. I'll go bankrupt. I'm not, paying all this stuff." They buy a house for $500K, and in like 6 months, it's worth like $300K, and they're paying mortgage on more. So this is like the worst case scenario. I mean, I don't want any of this to happen, but the bond market is scary. I mean, we need to, this is why I do what I do. This is what I talk about in my book, Asset Revesting. My whole focus is I have gone through bankruptcy. I've lost everything many years ago, my family. I know what it does to your psyche. I know how it can almost kill you from your health. It is extremely stressful. We are in a point right now where we have the largest group of people near retirement or retired. The last thing they can afford is to watch the price of their bonds get cut in half again, or to watch them lose their life savings when everything has gone up like 50 or 100% in cost or more. Inflation is through the roof. I don't care what the government numbers say. Stuff is not cheap. It is way more expensive than it used to be. And if people lose half their life savings, I mean, it's just going to devastate the retirement community. And that's my whole focus, is how can I protect everyone from this? If it doesn't happen, great. We'll just continue to make money. If it does happen, you'll probably end up being one of the wealthiest people around that because you wouldn't have lost your shirt. In fact, we're going to benefit from a huge collapse and a breakdown. So the bond market is a very scary thing. There's a lot unfolding, and nobody knows where it's going. The key is to have a very defensive, pessimistic mind, saying this is what could happen. This is what is, I believe it's very likely to happen. And so you got to have a game plan. And this bond market you bring up here, I mean, man, this is going to be pretty devastating if the bottom falls out. I mean, look at the TLT ETF. Let's just move into the TLT ETF. And I'll just zoom in a little bit. Look at the volume on the chart, right? Like everybody has been bottom picking. You look at the volume, everybody since this big washout low here is loading up on bonds, and they think like this is it. It's a major support level from way back in early 2000s. The yields are about to top out, and we're going to see bonds go for another run and become a safe haven play. What if that doesn't happen? If this bottom falls out, holy crap, man, there is going to be a huge fallout in terms of people's financial wealth. Financial institutions are going to get hit very hard who play the price of bonds. It's going to be difficult. So you bring up a really good point. I mean, this is not what I would want to see, but man, you better have a game plan ready because we have worked so hard to build the life you have and get the wealth you have. It can be wiped out in 3 to 6 months. And then it goes so fast, you make your head spin. And there's nothing you can do about it. Once it's done, you're lost. You're screwed, right? And so that's what I believe in. We have all the tools, even AI, to help us identify when something is trending up or down. There's no reason to hold assets falling in price anymore. That's just ridiculous.
Yeah, for sure. Yeah, I mean, and this also aligns with if the dollar, screams higher. Because if the bond market, falls significantly like this, all assets are going to get sold. Everybody's going to try to get liquid. Gold sells off, stocks sell off and everything. And you could see like a huge spike in the dollar. And so, especially for liquidity. So I could definitely see that happening.
And the dollar from a long-term standpoint, I mean, It bases and then it rallies and it bases and it rallies and it's basing. It's carving out what looks to be one of these lows that you see just before a huge move to the upside. If the dollar screams to the upper end of this range, that's an 18% move. I think it's got potential to go up 20+%. If gold screams that high, we're going to see, that means the economy and the world economy is weakening. Precious metals are going to get absolutely slaughtered. It'll be there'll be so much regret of people going, oh my gosh, silver and gold were that high and now it's back down to where it was from 10, 15, years ago. I just don't believe in holding stuff falling when we can identify all of this stuff. And the charts are pointing to mass chaos around the corner. I've been saying this for like 3 years. Just because I say it doesn't mean you want to start positioning for it. We have to wait for it to actually happen. But man, I feel like we are weeks or months away from a massive turning point, meaning the dollar up, metals break down, equities break down, and we see a huge financial reset. Like 2008, it will crush people. It will destroy businesses. It is an opportunity for those who embrace it, understand it, and are prepared. But unfortunately, for like 99% of people, they just go under, they lose their jobs, they lose money. It's just all around terrible scenario. And that's what I believe we can completely avoid with a little bit of effort, a little bit of focus, and not getting caught up in the noise. Just follow the price.
Yeah. So is your word of advice or caution to like your subscribers? Is it more of like, okay, we should be taking a little bit of these profits off the table, building like more of a cash position? Because like most of the folks I've been talking to, they're building more liquidity. And so curious in your thoughts there. Yeah.
I mean, we got into a recent QQQ and an SPY trade. Also, we locked in gains on QQQ on the 14th. So yesterday, depending when you're watching this, we just locked in gains on the SPY today as well, as we're hitting right up near all-time highs. So we were in liquidity. We exited the market right over here. We let the market reset, and then we got back in, and we just hit our first targets for both of those. So we're building up liquidity. We're selling into resistance. We're selling in a little bit of an overbought market condition, locking in some gains. We still hold the positions. We just trimmed off some of it to lock in gains and move our stop to our entry price. So now we just have a free trade. If this market just keeps running, we just ride the indices higher. But I think, not very long ago, we were 100% in cash because you don't know if this correction here was going to keep going or if this bounce was just going to roll over and sell off and keep going. We have to follow the market and the trends, the flows of the money. So people need to be ready to raise capital very quickly. Those who are doing it, I think it's a very smart play, but it can catch you if you don't have a strategy to get you back in. If the trend turns up, you're going to get left behind. And FOMO, feeling of missing out, like when we hit all-time highs here probably today or like this week, those who exited their positions or who are short are going to have some serious pain of like, how am I on the wrong side of this? I need to be in. Everybody else is making money but me. And, raising capital is only good if you also have a strategy to get you back in, put the capital back into the market to get it to work again. Unfortunately, people are driven by emotions, fear of losing money, and they'll step aside and they won't play this market. Things may not make any sense right now to hit all-time highs. We got war, we got all this stuff going on, valuations out of whack. Doesn't matter. Like I blew up one of my trading accounts back in 2000, owning in the 2000 tech bubble burst, owning the strongest companies. All I did was buy stocks that had quarterly growth, and I did covered calls on them. It was an epic strategy on the way up. Every month you made like 7 to 15% selling covered calls on your stock. It was a no-brainer. I kept doing it with the best companies on the way down, and all of the stocks fell 50 to like 80%, and I lost pretty much everything. And so owning the best companies and following good news will get you nowhere. You just have to follow price. As much as people don't want, they're like, you need to know what's going on in the news. Technically, you don't, because I don't. I really just let my kids and my wife update me. I mean, I keep the pulse on what's unfolding, but it plays zero power in our decisions of what we're doing. Just, follow the money flows. We got about 8 different things that we track for money flows. It tells us. We knew when this started to bounce, we could see right away. This market is not just a bounce. This is actually a new trend. This huge money is piling in before the retail investors kind of get in. So this gives us that insight of what's going on.
Okay. Yeah, definitely. I'm curious how many of those best companies from 2000s are still around from 2000 that you invested.
No kidding. Yeah. Well, Palm Pilot's not around. That was my first trade that I ever did. I made a fortune on it, but yeah, it went under still.
Yeah, for sure. So I'm curious. So quality names. So like for me, like I've been building a cash position, but I've also been looking at names like Visa, Microsoft.
I don't know what Visa
Salesforce. So Visa is just V, I believe, ticker V. But these are this company. I mean, you look at their balance sheet and all of that. Like they're like strong, very strong.
Yeah.
And so, I'm like, okay, there are some like quality names that are selling off. And so, curious in your thoughts on being able to invest in those types of names that are selling off that are high quality.
Yeah, I think people need to eventually kind of, go to the Warren Buffett model so let me step back. So if and when, well, it's just a matter of when we have a big financial reset, when everything sells off and we see a huge correction, that's when you go out like a Warren Buffett. You say, listen, I'm not picking stocks. I'm picking companies, right? I want to buy the strongest companies that are positioned and they're rock solid. Their stock has been beaten up, which is a bonus. You're getting it at a discount. You want solid companies that have good management, and you invest in those companies. And I mean, I think Visa is a great company. I mean, I have multiple different cards for different reasons, but Visa's like, they have the best thing. It's like, don't leave home without it. It is the only card that you can literally take anywhere in the world, and it works pretty much everywhere. You got like a MasterCard or American Express and stuff. A lot of people just don't take that stuff, right? So like companies like Visa, I think when there's a financial reset, I think is a huge opportunity to get into the best companies. And you can literally just copy Buffett, right? After a big reset, you can go look at the portfolio and say, I'm going to pick, a bunch of the companies. They've already done the due diligence. It's all public information, and you can just go ahead and do that. So that's the way I would see it. I'm not a big fan of investing into companies in this type of market condition. I want to wait for a reset. Like I remember owning Tesla back at $38. And of course, you have to go way back in time to see that. And of course, it's up dramatically from there, right? And so there's companies I want to get back into. I haven't owned individual stocks in like 10 years or so. I really just moved and focused on ETFs. But when we have the next big financial reset, I will be going out and selecting a bunch of individual companies for some positions that I think I want to have some extra exposure to. But you need to wait. I think you need to wait until things are beat up really hard. Visa also had that bad news, unfortunately, with I think it was Trump talking about capping the interest rates or something like that. And I can't remember. It was probably somewhere around this drop, which hurt the credit card companies, just saying, hey, you can't jack up your rates or have 20% interest rates or 30% rates. And I think he did something. I don't know if it got implemented or not. It's hard to tell what he says if it ever gets implemented. But it hurts these companies temporarily. But eventually, I mean, it beats the price up. And then, of course, when that rule gets lifted down the road, you're like, okay, well, now they can jack up their returns and fall back to their normal rates. So there's lots of opportunities. It's just, it does come down to timing. I think there's times to invest into individual stocks, and I think it's only after a bloodbath. That's how I see it.
Mm-hmm. Yeah, for sure. Let's go over to silver.
Right.
So silver obviously had a huge blow off top, and it's been trying to find its way. So curious in your thoughts on silver.
Yeah, so silver is fairly similar. Obviously, huge, massive reset in price, a huge crash, just clearly telling us that this was a FOMO-driven move. Usually things that go straight up come straight back down. Creates a waterfall effect. But when we look at silver, again, it has a very similar type of move. It actually had this first initial drop. It's had this bounce. And if we carry that forward, it's showing we could see silver all the way back, right? Let me just draw a line across here. All the way back to the same time, which was more so July, August, which is where silver really started to ramp up in its euphoric phase and went parabolic. Gold did that right over here. Gold broke out a little earlier. Silver followed suit. And so based on this drop and this bounce, it's telling us that eventually we should hit the 618, which we have. And if you bounce off the 618, usually you're going to go down and hit the 100% measured move, which is $39, $40. That brings us right back down to anybody who is late at the game, investing or buying silver during this euphoric phase is going to be under pressure, and it could take them years to get back to whatever price they paid. Like the majority of people probably paid on this leg up here. That's when the newbies kind of really got sucked in and piled in. And I remember you and I talking at VRIC. I mean, there were some new people who had never bought metals before buying silver, up over $100 for their first time, and they were super excited. And I'm like, oh my gosh, I'm like, the bubble is here. But when we look at the shorter term picture here, even this move down, this is a bear flag. It's coming right up through the noise, right across this resistance, through all of this noise, through this support level, this breakdown level. And so we're getting right into this zone, right? And eventually we could see this have another leg down and sell off. So again, silver and gold have the similar type of scenario. I think either way, I mean, we're going to see higher prices eventually, but the big thing here is silver has got this massive run up. It's got this huge bull flag. The question is, how far does it continue to flag out? If we just go, zoom back in silver here, how far does it flag down? And then eventually it's going to take off. So that's what we need to see. If silver builds a launch pad and starts to build a base and starts to break out, then at some point we're going to want to get back in when a strategy says, okay, it's gone from a downtrend to now it's in a confirmed uptrend. Let's get in because it's going to want to take that next run to like 140, 200, whatever those next targets are. So.
What do you think about silver? So we talked about gold being in the teens for, maybe in 10 years or whatnot. What do you think the long-term price on silver could be?
Yeah, I mean, depending on where price pulls back, let me just zoom out a little bit further here. Let's just go back and look at the big picture. Actually, we'll maybe just drop down to the weekly chart for a cleaner view. Silver has these giant euphoric moves, which make it really hard to gauge. I can give you an upside target, but then it'll blow right past it. And that's how we knew to get out of silver. Once silver breaks 106, it's just gonna pop and it's going to be a euphoric phase and we got to get out. And so I can give upside targets, but it can blow way past it. So if we were to just take a look at silver and we were to just base it on Fibonacci, based on the last major cycle low, which was actually COVID for silver, we have this peak high. Depending where silver pulls back, right? If silver pulls all the way back to 40, let's just use this most conservative view. Say it pulls back to 40. it's going to tell us where that next upside target is. The next upside target is going to be 150 for silver. Now, if silver has found a bottom right here and it starts to build a launch pad and starts to build a base to go higher, well, you're going to notice that green upside target dramatically moves. So if we move this up to this low here, saying that is the low, it moves silver up to about 171. My belief is if we start to see it reverse and start to head higher from here, 171 will most likely get hit, but it'll also probably blow way past it because it'll turn into another euphoric type of phase. And again, that's exactly what we saw on this chart, right? Like this is the euphoric thrill phase, and then it can have a reset. So that's the big question. Have precious metals, is this their warm-up run before one last big euphoric push higher? Or did it just have it and now it is going to go dormant for a while? And that's what we need to kind of wait and see. You know, the crazy part is, like, look at this chart pattern, Daryl. If we just, let me just clean it up a bit, rebalance the scale here. If we look at this chart pattern of silver, I think I have it over here. So here's a chart pattern of silver. The top one this is an earlier chart. We'll just look at this one on the right. We had the big pullback. We had this bounce up, this move down, this bear flag forming where we are right now. Well, in 2011, it did the exact same thing, almost the exact same type of pullbacks. We had a huge euphoric move up, pulled back 30+%. It bounced 30+%. And then it sold off, made a lower low, put in a bear flag, and then went sideways. I mean, if we were to look at these moves, a 30+% move down, 30% move up, we pretty much had that, right? We had a 45% move down. We've seen since then, a 50% bounce back up. We've got this bear flag. And now it is saying that eventually this should roll over and go out of favor. And just look what happened in 2011. 2011, this is what it did. It put in this bear flag. It chopped around for a while, traded sideways for about a year and change, and then it totally fell out of bed and went dormant for 14 years. So that is possible, right? It might not happen, but that is possible. Either it could go dormant for a decade and you will have wasted 10 years of investing, or it screams higher and you want to get back in and ride it higher. You don't want to sit dormant for 10 years. I mean, I've seen and talked to a lot of investors who have had precious metals and miners for that whole window. And then suddenly, in a few months, you get this huge move and everybody's like, the move just started. I waited 14 years. It's just getting going. I'm like, no, you wasted 14 years. And now the move is almost done and you think it's just getting going. I'm like, this is the psychology of the market. It puts you on the wrong bloody side. It puts you in trades that suck, and it'll hold you into trades until you give back all those gains. And so that's the view that I have. I like to think I have an unbiased view. I show what the charts are pointing to, what could happen. And on top of that, I have strategies that tell me when to get in and when to get out and when to lock in profits and things like that. So you need to have all of that figured out, or you'll never be able to, get the most out of the markets. I'm all about efficiency. I want to make sure I protect my capital. Number one, if you protect your capital, you protect your lifestyle, and then we focus on making money. And if you don't have big losses, you don't actually have to have huge returns to make money, because you're not clawing back from these random big losses that you end up taking in other places.
Yeah. I mean, it's important to note that, folks that did sell during the 2010 to 2011, spike up, they probably sat in cash. There's some folks that sat in cash and accumulated during the sell-off. And so, like you mentioned, if silver goes down to 40 or gold goes down to 3,500, that's an accumulation phase.
For sure.
And so you shouldn't be just accumulating heavy amounts at significantly higher prices. So I'm curious in your thoughts on, obviously, if silver goes up to like $170, $200, whatever the case may be, over the next however many years, at some point, granted, like these don't make profits, they don't pay dividends, but I'm thinking about Warren Buffett investing in Coca-Cola, and it's like, okay, Coke is probably never going back to the prices that Warren Buffett bought, back in whatever the 70s, 80s, or whenever he invested in that position. And so, do you think at some point, like, we will get to the point where we may not ever see like certain prices on the metals again?
Yeah, I mean, I think we probably won't see $20 silver again. Like we're never going to see those bottom barrel pricing. I don't think ever again, unless there's some crazy chaos and there's some huge. Unless a giant meteor hits Canada, hits the earth and it's a giant gold ball that's like 10 miles wide. Like, unless that happens, I mean, we're probably not going to see, gold and silver prices, I don't think, fall to like, $4, $5, $10, $20 again. I think I think that window's moved. I think we've now moved to a higher tier of pricing for all of the metals. But I mean, yeah, you're right. I think if you've got metals at a really low price, you're a long-term investor, and you're younger, I think you can ride this stuff out if you want. I'm focusing. My protection is like focusing on people who don't want to give back huge gains of their life savings. They're older, closer to retirement, and they don't want to withstand a 5, 10, 15 years of watching their accounts drop and have to downgrade and tighten their belts when it comes to financial spending and giving and all of that stuff. So, and the nice thing, I mean, you bring up like the Buffett and Coke. You can get into these companies after a financial reset, and they might be paying, when you get into them, maybe they're paying like a 5-7% dividend at that point. You look forward, like for Buffett, from his first shares he bought in Coca-Cola, those shares he bought and the dividends just keep going up. He's probably making like 100 or 300% return just from his dividends every year on those initial low price stocks, because he's probably making like huge dollar wise, right? Like it's crazy. And that's why, long-term investors, if you can buy in, if you can keep your money and your gunpowder dry as the market vaporizes and collapses, you can then push your chips in, buy the best companies that are rock solid, move forward long-term, and they pay dividends. And you just let that keep on going. And you literally have a huge passive income and huge dividend payments, which are, great way to get money out of the markets at a lower tax bracket. But I think you need to just wait for those opportunities. And when that time comes, that's what I'm going to be doing, is looking to pick a handful of companies, probably some dividend paying ETFs as well, that are focused just on dividend companies. And you park that for the next major bull market that could last 5, 10, 15 years or longer. Who knows? So you have to change your strategies depending on the market conditions. Right now, I think everything carries a ton of risk. And I think you're better to be more protective and still capture the upside, but be defensive. You've got to move aside very quickly if this market starts to roll over, because one of these pullbacks, one of these dips, everybody who keeps just buying every dip, it works great until it doesn't. And then suddenly, you go from having huge money to like, holy crap, I just lost half of my account. And you keep averaging in on all these dips because you're like, well, this one will be a bottom. This has got to be it. And you keep adding more money at higher pricing and it keeps falling. And that's what I want to avoid. I've been through a bankruptcy once. I don't want to do it again. I like my lifestyle. I don't want to give it up. When we have all the tools and software to be like, hey, this is going down now. Let's get the hell out.
Yeah, for sure. So as we wrap up, can we look at the miners?
Sure. Which one?
So let's look at the GDX or GDXJ, either one.
Sure. Yeah. So I'll just go back to, we can go and look at the weekly chart. So this goes all the way back to 2011 market peak. It based out for a very long time, and then really just in the last year or so, it's popped and made some all-time highs. It's got lots of volatility through here, a lot like gold and silver. This isn't the most bullish chart pattern, right? Like we've got a move up, it got slammed. We have another surge to a high, it got slammed. We have another surge. I call this 3 surges to a high. Usually it turns into a huge correction and some type of bounce, and then it goes out of favor for a while. So, all the big picture, when we zoom out and look at the big picture of the dollar, what precious metals are doing, what miners are doing, what bonds are doing, like what the equities markets are doing, and all of that stuff, they're all pointing to like we are right near the end. The music is about to stop. And we've seen this in the past. You go back in history when when the biggest companies in the world are rushing to go public at the same time. And right now we've got SpaceX, we've got OpenAI, there's a whole bunch of other ones worth hundreds of billions of dollars, all rushing to do their IPOs right now. It is not a good sign. You got to think these super sophisticated investors and entrepreneurs and potentially huge insiders, do they know something's coming? Like they want to literally liquidate, get their stock, get money out of people before the world tightens up, wallets shut, spending turns off, businesses start to flounder. And so that's not a good sign. And so all this stuff is pointing to lower pricing. And I don't think people should look at this as a bad thing. In fact, most of my subscribers, we are drooling for a huge market reset. Like that's what we want because it's potential to make money on the way down. And then we can reinvest in all kinds of stuff, not just stocks. We can buy metals, we can buy companies, individual stocks. You can actually buy physical companies or equipment or real estate. This is going to be the opportunity of a lifetime. The key is just don't get caught in the avalanche, pull the chute, let the avalanche happen. And then when it all lands, you can come down and reinvest near a market low. So miners have the same outlook as gold and silver. Right now, it is deciding, is this a bull flag and we're going to have one more huge push, or is it done? Is the damage has been done? It's broken the uptrend, and now it is just going to flounder for a while and eventually break the hope of everybody that it's going higher and start to go into a bigger reset. We're neutral. We don't hold precious metals. To me, it's trendless at this point. We want to wait to see what's next.
Okay. And then I just thought about this, but lastly, can we look at the VIX? So you mentioned making money on the downside. Obviously, the VIX is a way that folks can do that. So curious in your thoughts on this chart.
Yeah, so this is the weekly chart. It gives you a view of kind of how high the VIX can go. I used to trade the VIX using ETFs. I don't trade it anymore. I got into an ETF that literally imploded. I just don't trust them anymore. And we lost like 87% of our position overnight. Thank God it was a tiny speculative play, which is what you do with the VIX, only small positions, but it's just enough to piss you off. You'd be like, I do not trust the way the financial systems and these instruments are made. So I don't touch it anymore, but there's no doubt, I think there's going to be huge opportunity in the VIX. And, I wouldn't be looking so much to catch it from a spike. I find it very difficult to catch the spike. I think the key is to scale in. If I was to be an aggressive trader during this scenario, to scale into the VIX after it's had a huge spike and it kind of keeps going, I'd scale into a position so that as the VIX comes down, the ETF goes up in value. Because over time, the VIX fear spikes, right? If somebody jumps out at you and scares you, it's like your heart, everything, your heart's pumping, you feel it in your neck throbbing, right? But then you fade away really, over the course of minutes or days, you'll fade down. And the markets do the same thing. They get a jolt of fear, markets collapse, big news hits, and then suddenly it'll just fade and go back down. So to me, it's like, everybody wants to make money on the collapse, but I find it's much easier to make money, almost after the collapse. You let that happen, and then you can scale into the VIX as a very small speculative play and expecting the VIX to fade and for the markets to eventually stabilize and start to turn higher. But a lot of people trade the VIX. It can be it's very lucrative, but you got to be very sophisticated, very disciplined to trade it, because it pops and drops very quickly, right? Like you're in a huge profit, in the morning, for example, if you're long, you're up here, you're like, oh my gosh, I'm rich. And by the end of the day, you're like, wow, I gave back everything. I got in right over here. It's like, and that's in one day, right? So it's really difficult to trade it.
Yeah, for sure. I think some people may want to hedge. Obviously, some people just sell and take some profits off the table and just sit in liquid cash and just wait for the next opportunity, which that's fine. And then some people want to kind of hedge while they stay invested, hedge their positions. Yeah,
and my view on the VIX, there are millions of traders. There are millions of ways to trade the market. I found the time frames, the style that fits me. There are people who live on just trading the VIX. It's just not my style. So I'm just sharing my view, why I don't like it myself. But there's ways to make money. You can slice this up a million ways, the markets, and trade it extremely successful, right? I just have a way that works with the type of capital, the amount of capital that I have, the amount of time I want to, put into the markets, the amount of volatility and all of that I want to take on. So again, there is no wrong way to trade. If you've got a winning strategy, there is no wrong way. You can day trade, you can scalp, you can trade just one instrument, you could trade a plethora of strategies and instruments. I rotate through various strategies. My strategy changes as volatility, as market conditions change, and I focus on ETFs, and I'm looking for trades that generally last a couple of weeks to several months. I want to catch trends. I want to keep it really simple. I either own equities or bonds or a currency, or sometimes we'll move into metals and different things like that. But that's just my style, right? And everybody's got their own way. And
I just wouldn't play options on these types of ETFs. I used to try to hedge by playing options on these ETFs, and then they roll over like as they keep going downward. They end up like rolling over the equities, and it's chaos, like trying to play these types of ETFs and like the VIX and such. And so it's something I've been staying away from because I've lost money on it.
Yeah, I'm personally not a fan of hedging. I think if you're hedging, it means you're worried the market is about to roll over. You've got warning signs, and in my opinion, like a hedge costs money. You have to put it on. If it's going to counter the move of the other play. If it doesn't work, it backfires. Emotions take over in a lot of cases. So you end up making an emotional decision and taking a loss with your hedge. And so it's now cost you even more. And so I'm not a fan of a hedge, because if I think something's rolling over, if the charts are saying, hey, price is rolling over, I don't go out and say, I'm going to buy a hedge because I want it to keep going up. I'm going to be like, the market's starting to roll over. I'm just going to get out, and I'll just buy it back later, either at a higher price when it's already confirming it's in a new trend, or I'll buy it back lower once it's put in a bottom and started a new trend higher. So hedging is really difficult. It's very difficult for multiple reasons. There's a lot of human error involved. Emotions get in. You'll turn a hedge, and instead of a hedge just being neutral, it might turn into a big loss for you, because it's not as easy to put a proper hedge on as a lot of people think. Position sizing, all of that stuff, volatility. You got to factor so much into hedging. I'd rather just be like, it's trending up, I'm in. It's trending sideways or down, I'm out. Let's go move to a different asset class and see what's moving, right? So,
yeah, for sure. Yeah, I think what was happening was, I would buy these inverse ETFs. I would buy call options on them. And then they would do, like, the price would just keep going down, especially in like a bull market. And then they would do like these reverse splits. And then I would be stuck in like the option and can't get out and such. So I was just like, man, I'm not doing that again.
That's what makes us better traders, though, right? Like, man, you got to make mistakes. You got to find out what works, what doesn't work for you. I mean, that's the school of hard knocks is the best way. That's how I learned through trading. I've lost a lot of money. I've had a lot of great trades. I've given all the gains back. I've blown up 3 accounts in my lifetime. I know exactly what doesn't work. I know what carries a ton more risk. And I just, you just pivot and shift from whatever you learn. You just roll it into your new strategy to make sure you do it or don't do it, whatever it is, and go forward from there.
Yeah, for sure. Well, Chris, appreciate you coming on the show and everything. Obviously, you have a book, you have your trading subscription service and such. Plug the audience with where they can access this.
Yeah, I mean, the best spot is you could go to my YouTube channel, The Technical Traders. I share some videos there of kind of what I do. I walk through the charts like I did today, but on a more granular level, kind of zoom into what's going on, moving. And but overall, you can go to my website, thetechnicaltraders.com. There I manage my own portfolio. I share my exact portfolio positions and trades as alerts with you, with subscribers, and we navigate the markets. And I update every day, teach you kind of what's moving, why it's moving, how everything's related to each other. If one asset goes up, it's going to affect something else somewhere else. The markets are all interwound and connected in some way. And it's just highly educational. So you can just navigate, trade the same ETFs with me, ride the markets up, benefit from falling pricing, avoid, crashes, and, take the markets in a much more controlled way and kind of have a clear path to the future and not hope that you're going to survive and not blow your account up. I focus on not doing that. So it's just a matter of inching our way higher, slow and steady growth year after year. Doesn't matter what the conditions are, which way the markets are going. We just follow the markets, follow the money, and it really cleans things up.
Yeah, for sure. Yeah, appreciate you sharing that. You all be sure to go check out thetechnicaltraders.com. Hit the subscribe button if you have not subscribed yet. Love to have your support, and thank you for watching.